you so very much to the organizers, Dima, Neil, and Christian, for having me here. This is a fantastic opportunity for us to get your feedback on this paper. And this is joint work with Svetlana, who is also in the audience, and Taisiya, who is finishing her job market. So the dominant paradigm in the literature studying limits to arbitrage and arbitrage in general is the competitive arbitrageur paradigm, whereby arbitrageurs are atomistic. Yet in practice, we often observe just a handful of large arbitrageurs operating in some markets because of high fixed cost of entry or because of economies of scale. So these arbitrageurs may act strategically. Moreover, in many applications, arbitrageurs interact repeatedly, which gives rise to repeated games considerations. So in this paper, we propose a theory of limits to arbitrage with strategic interactions and repeated games. And another feature of our theory is that in some markets have natural arbitrageurs, for example, leading dealers or market makers who are close to the order flow and are naturally positioned to take advantage of arbitrage opportunities in their markets. I will tell you, of course, everything about our empirical applications soon, which is to the options market. But let me just briefly outline what we do in the theoretical part of the paper. So in our model, there are multiple markets, each with a per period entry costs for each intermediary. And intermediaries act as arbitrageurs, and there are few of them. A natural market for an intermediary is one in which her entry costs are zero. Repeated games in our model give rise to an equilibrium in which arbitrageurs do not step on each other's toes and enter a non-overlapping subset of markets. That way, collectively, they pay lower fixed costs. If a market is a natural market for some arbitrageurs, in equilibrium, no other arbitrageurs enter this market. This is, of course, a tacit collusion equilibrium. And we stress that in a repeated game, it is a non-cooperative, sub-game perfect equilibrium. And now to the application. So we, as a laboratory, we use a virtually riskless arbitrage strategy in the US options market known as dividend play. This strategy is executed from the trading floor and primarily at only 2 exchanges in the United States. So trading is predominantly electronic these days, as you know, and an options exchange floor looks more like a library. Now, these trades are normally prearranged by pairs of arbitrageurs, and we exploit a new reporting requirement in which we can accurately identify all arbitrageurs' trades in our data. We know all the trades, we just don't know who is making them, but we can identify which ones are dividend play trades. Now, to the findings, we find that dividend play arbitrageurs enter only 57% of profitable arbitrage opportunities, which are options contracts in our application. In contrast to standard theories, more profitable arbitrage opportunities do not necessarily attract more entry. And of arbitrage opportunities that do attract entry, 50% are exploited by only one arbitrageur. All these implications are consistent with our tacit collusion equilibrium, and we argue are inconsistent with standard theories of arbitrage. Now, given the audience, I will focus primarily on the empirics. So let me give you just a flavor of our model in pictures primarily, no equations. So we have an infinite horizon repeated game setting. There are 2 players, intermediary 1 and intermediary 2. Each period, they can participate in one of three markets, M1, M2, and M3, albeit at a cost. Market M1 is a natural market for intermediary 1, meaning that her entry costs are 0. Market M2 is a natural market for intermediary 2. And the third market is a natural market for neither of them. So in each market, there is an arbitrage opportunity of a fixed size, A or A star, occurring every period. And intermediaries need to commit some resources K to harvest these opportunities. Their share of captured arbitrage opportunity is given by their market share in the markets. Now to the equilibrium. So let us look at a stage game, just a one-shot thing. And one can show that there is a unique Nash equilibrium in which arbitrageurs, as a usual intersection of best responses, in which arbitrageurs enter all markets. As you would expect, they allocate more resources to higher value arbitrage opportunities. Now, in the Nash equilibrium, intermediaries are jointly paying the maximum per period fixed cost. Why? Because they're entering all of the markets. So this allocation is clearly not Pareto optimal. An allocation whereby both arbitrageurs enter just their natural markets, but not the natural markets of their opponents, yields exactly the same arbitrage gain, but at a lower fixed cost. So to generalize this reasoning, let me show you the Pareto frontier of this game, the set of Pareto optimal allocations represented by this colorful line here. The only point I really want to make on this slide is that the Nash equilibrium is not on the Pareto frontier. And this symmetric Pareto efficient allocation, the blue point, involves intermediaries staying away from each other's natural markets and splitting the third market. So this is not an equilibrium of a one-shot game. You really need a repeated game to support it as an equilibrium, but you can do so in an infinitely repeated game, and it can be supported as a non-cooperative subgame perfect equilibrium. So this is what this equilibrium looks like in our model. We have a tacit collusion equilibrium in which intermediaries do not enter each other's natural market, and they alternate in the third market. In odd periods, intermediary 1 enters. In even periods, intermediary 2 enters that market. And this equilibrium achieves the maximum savings in terms of the entry costs and delivers the highest combined payoff to the intermediaries. So that's it for the model. Let me just summarize the testable predictions, all of which we find in our data. Prediction number 1, there should be no entry into natural markets of arbitrageurs. Prediction number 2, if a market is neither arbitrageur's natural market, we should observe only one arbitrageur entering that market. And prediction number 3, if the arbitrageurs are not playing cooperatively or repeated game, but are playing this one-shot Nash equilibrium instead, they enter all markets. And if so, then the higher the value of the arbitrage opportunity in a market, the more resources they would allocate to that market. And now let me move to the application, which is from the options market and to the strategy known as dividend play. So the data you would be very well familiar with. So we have transaction level data from Opera. And since the previous paper, we have been using these wonderful new trade flags that Opera now has that start from November 2019. We'll use them to identify arbitrage trades. We also supplement this data with option metrics, with CRISP, and the NASDAQ photo and noto data that we got. So let me first establish some stylized facts about this dividend play arbitrage. And what I will do here, I will compare the dates. Let me just show you the spikes. So basically what you see on this picture is the daily volume in options on a one specific ticker, ExxonMobil. And what you can see is these amazing spikes that happen periodically. So these spikes happen to occur on the last day right before Exxon goes ex-dividend. And this abnormal trading volume is due to this dividend play arbitrage. And we're talking really large numbers. So the average volume on ExxonMobil is on these dates on which this dividend play takes place is almost 100 times higher than on any other dates. And in terms of dollars, it's 100 times higher. So this is big. You can also see that after 2014, this trade has gone down. Why? Because there was a crackdown from the SEC on this trade. But recently, it has been experiencing an enormous revival. So let me establish some stylized facts about this trade. And what I will do, I will compare these last cum dividend dates on which the trade takes place with all other dates. So first of all, you could see that this trade is executed from the exchange floor. And in fact, there are only two exchanges, Philadelphia and Boston, that attract most of dividend play. So this strategy focuses on the in-the-money call options, and the trade sizes are very large. So the way I'm making this statement as I'm just comparing the cum dividend dates with any other dates. Now, effective trade costs, however, are smaller on dividend play dates. And this happens because dividend play trades are normally prearranged and they occur close to mid-quote. Now, the specific trade flags that we exploit in our data to detect these dividend play trades are the one for single and multi-leg floor trades. So the spikes that you have seen come from exactly those trades, single and multi-leg floor trades. Moreover, it turns out that Felix and Boston offer daily fee caps, which is specifically on dividend play trades, and in fact on 6 other strategies. So what is this fee cap? It is a cap on the daily trading costs if they are executed from the floor. That's why these two exchanges capture most of this activity. Now, to connect this to the model, remember there were these fixed costs in the model that occurred every period. So that's these fee caps are effectively per contract trading costs, and they are capped per day. So this would be the analog of our trading costs, entry costs. And why repeated game? So you could see that this trade happens repeatedly. Every time there is a dividend payment, there is a trade, right? And there will be fee caps on those trades. So costs of entry are really fixed. All right. So also I have mentioned already that we have spoken to market participants, and these dividend trades are normally prearranged by floor participants, and these trades are usually not exposed to other market makers' quotes. Okay, so you know what, maybe should I pause 1 second to see if there are questions? I cannot see the chat, unfortunately.
There are no questions in the chat so far. It's a sign you've been very clear.
Okay, sounds good. So in that case, let me now explain this strategy. So suppose that there is one American call option contract outstanding, and it is optimal to exercise it right before the underlying goes ex-dividend. So options are a zero-sum game. If a dormant investor fails to exercise it, this mistake creates a windfall gain to the option writer. Now, what does the dividend play do? Dividend play arbitrage diverts this gain from the original option writer. How? On the last cum dividend day, an arbitrageur would write a large number, let's say 100 call options, and will also simultaneously buy 100 nearby calls to hedge that position. So since there are 100 newly written calls, now there are 101 contracts outstanding, the original first contract and 100 additional written contracts. Now, there is still going to be one contract left unexercised by this dormant investor who fails to do so. And so now one out of 101 contracts is going to be the lucky one that will receive the windfall capital gain. The assignment of which one of the 101 is the lucky one is random, and that's important. And because arbitrageur holds 100 contracts out of those 101, she is much more likely to hold the lucky one and hence pocket the windfall gain. The bottom line is that the size of this windfall gain doesn't change with arbitrageur entry. But what happens with arbitrageur entry is that this windfall gain is almost surely diverted from the original option writer to the arbitrageur. So this is and we will study arbitrageur activity in this market, in dividend play.
Can I ask a question?
Of course.
So I guess, does the arbitrageur know that there is one option when they buy the 100? Do they already know that somebody's asleep at the wheel?
They do not. But so let's look at the potential profits from this strategy. So what do you need for these potential profits to be greater than zero? So first, you want this option to be in the money. So have a high early exercise value. That is computable by Black-Scholes or other more sophisticated models. That they can do. You also want to have large open interest in that particular contract, which is, again, something that they can observe in the data. And you also need this important bit, which is the fraction not exercised, which is not available and need to be estimated, the fraction that will not be exercised by these dormant investors. We can predict it really well with one variable, which is retail participation. In our previous paper, we have come up with that variable, retail participation, and this is wonderful in predicting fractions not exercised. So if we can predict it, we think that market makers can predict it too. Does that answer your question? So it's not perfectly observable, but it's very predictable.
So a follow-up question. Can you highlight the important similarities and differences between dividend play and classic arbitrage plays like futures cash or call parity violation strategies? It seems like speed is very important for classic arbitrage, but not for dividend play.
Yeah, so dividend play, both are effectively riskless arbitrage strategies. So there's a tiny bit of risk, which I want to talk to you towards the end, but I don't want to go in the weeds right now. So they're both riskless arbitrage strategies. Now, in terms of the speed, the thing is what we see in our data, you will see the evidence in a second, is that there is only one arbitrageur going into one contract. There is multiple contracts, let's say written on SPY, would be 100 of them that are eligible for this trade. And what we see is that one arbitrager goes in one, another arbitrager goes in the second one, the third arbitrager goes in the third one. They subdivide them, do not step out in their toes. So what we see that most of these trades, they happen in the afternoon on the last cum dividend day, but not at a specific time. It's not like there is some really high frequency stuff going on, just a very large trade, which is executed over the a minute or two. So does that answer your question? So I'm trying to understand what you've been getting at, and if please ask a follow-up if I'm unclear. Lauren?
Yes, Anna. Earlier you mentioned the SEC had a crackdown during the 2015 something, right?
Mm-hmm.
So is this trade illegal? Because is it accessible to, say, ordinary investors, I guess, is what I'm saying? Or this is part of the market making of some guys doing it in, like your model, exclusive thing that they can only do. Can we do it? Can you do it in a sense?
Okay, so what we see in the data, that this trade is happening from the floor. Most of it, the majority of it, is happening from the floor of the exchanges. Now, could ordinary investors access the exchange floor? This actually, I wanted to hear your views about. So my understanding is that they are market makers there. They are these floor brokers, but definitely not retail investors.
Okay.
And so this is not kind of the main thing that they do. So there are plenty of other things, reasons why they're on the floor. So it's profitable trade, but it's not immensely profitable for you to seek a floor seat just for that trade. It's something that you do on the side, but you are already there. And why not make a 100 extra million if you can?
And the retail bid ask probably will be more than,
Yes.
more costly than the benefits anyway.
Absolutely, absolutely.
Okay.
These ones, though, so we looked at the trading costs, and they're minuscule for these trades, the ones that happen from the floor. So they are pre-arranged by pairs of arbitrageurs. We do not know who they are. We know that they're just on the floor. And these trades happen very close to mid-quote or at mid-quote.
Okay. So it's likely a distribution among the market makers, in a sense, like a profit sharing in a sense.
Yep, yep. So they definitely do not step on each other's toes. You will see what we
Well, I have
find.
a question, but I see that Stylianos has raised his hand. So Stylianos, why don't you go ahead?
Please go. Mm-hmm.
Yeah, one question, Anna. Who controls the trading platforms? You see, I'm asking this question because we found exactly what you found, that there are arbitrages, riskless, virtually riskless, in the market for credit default swaps. By the way, this is directly related to what you're doing, appeared in the Journal of Financial Markets in 2021, and in which the bulk of the control came because there was a small group of firms that acted as traders, and they controlled the trading platforms and, of course, acted as dealers there. So there was a case of information asymmetry. Did you see such things there or not?
Okay, so yeah.
Who controls the platforms, if PHLX or BOX? Because the credit default swaps were controlled, the market platform were controlled by a few large financial institutions there was a court case, actually. That's how we found out about it. Who controls these platforms?
Yeah, actually, I don't. So the exchanges, obviously, but I think what you are interested in is exactly what the names of the market makers and the firms that are on that or on the floor. Yeah. So I think we would ask Neil. Neil, could you kindly tell us who is there on the floor of these exchanges?
Well, I mean, I really don't know, other than market makers and members. But other than that, I don't know who chooses to be on the floor.
Mm-hmm. Yeah, so we unfortunately do not see this in our data. It's completely anonymous. So we don't know, but we will investigate and we will read your papers, Liano.
So I see that Asaf has his hand raised too. Go ahead.
Yeah, so I'm thinking back to your example, and you said that these are pre-arranged, and that sort of makes me wonder who takes the other side of those 100 trades.
Oh,
So
that
if
was
you're
going to
really
be my
close-
question too, but
Oh,
actually.
sorry for
correct
taking it.
answer.
Yeah.
Perfect, perfect.
Right, the answer is market makers, and then they exercise the options optimally.
Yes, absolutely right. So what we would do, so for example, Asaf and I are engaging in this trade. I will write 100 calls, and Asaf will provide the other side to me. And at the same time, Asaf would write 100 nearby calls, which are also profitable, and I will take the other side. Remember, the person who pockets the gain has to be the option writer. It has to be short. So I will profit on the short contract, and Asaf will facilitate this trade for me, and Asaf will profit on his contract, and I will facilitate on another contract, and nearby one, and I will facilitate it.
So what you're describing doesn't sound like tacit collusion. Sounds like
Yes, I know.
outright.
We were presenting this paper at the NBR, and Daryl Duffy raised his hand, and he had exactly the same comment.
Yeah.
So, but it's not, obviously, there is absolutely no public record of that we could come up with.
Okay.
Looks
So
like a
what
market
the
maker.
WhatsApp call.
Looks like market makers trading against each other deliberately, like no cost or whatever. All they're doing is sort of ripping off the option writer. Right?
Yeah,
So they
the original option writer.
They essentially sort of front run them in the sense of front running. But any guy who say outsider, if we want to trade, the bid-ask will prevent us to do this trade anyway. So essentially, they are right before those guys can exercise. They said, okay, let's exercise within ourselves. You know, I accept your trade, you accept my trade next time. So there's no bid-ask, whatever. It's just a facilitating a fake booking to sort of, what do you call it, short circuit the trade, right? Otherwise, if you don't do anything, all the money will go to the option writer, right?
That's right.
But by doing this artificial trade, essentially you are sort of short circuiting that.
Yeah.
Maybe that's why SEC is investigating, because
yeah. So in fact, they're not providing liquidity. They're not really doing any useful service to the market.
No, yeah, it's just essentially just ripping off the option writer, right? You're not doing it.
And in fact, there was a public lawsuit that we have been able to come up with of option writers against the big market makers, saying that you are stealing my gains.
Okay, that sounds like what they're doing, actually.
Yes, but it was ruled against the plaintiff.
Okay.
So I guess it's difficult to have this.
But you did mention SEC was cracking down on this.
Yes.
So there must be some stipulation to say, it's like in this high frequency trading, you cannot dump and switch, whatever. This is more
right,
like
right. But
like
so it used to be that before 2014, you can write and simultaneously buy the same contract, which would be an absolute perfect hedge. Yeah.
Okay. Yeah.
But they have made this impractical. So they changed the clearing rules. So you basically, this would not give you divert the gain. So it has kind of reduced significantly this trade, but then it came back. Actually, quite soon it came back. And we see it in our data. Instead of writing and buying calls in the same contract, going into the same contract long and short, they go long and short nearby contracts, which effectively achieves the same thing, but there is a tiny delta risk there because you're not doing the same contract. But it's still very profitable. And still,
so I think I'm worried about the time, so maybe we should let Anna move on and take more questions at the end.
Sure, yeah. All right. So now let me tell you about the stylized facts that we uncover. So on a given day, they are normally multiple contracts in which dividend play is profitable. Let me give you an example of two contracts on the emerging market ETF, EEM, expiring on the same date and very similar in terms of characteristic. If there is any characteristic we forgot, please shout at me or put it in the chat. We will add that one as well. Very, very similar. Now, the first contract is exploited. You could see the floor share close to 100%, whereas the second contract is left completely unexploited. Floor share is 0. Now, how much money is the foregone profit? We used our formula, I had it on one slide before, and works out about 18,000 in that contract in which the arbitrageurs did not enter. And this pattern, this selective entry into some contracts, is common across thousands of contracts in our sample. We see it across all tickers, including the most traded ones, such as SPY and Apple. So the first fact that we established, the document, is that only about 57% of profitable contracts attract entry by arbitrageurs. And overall, arbitrageurs capture only 49% of possible profits. So this is already outright inconsistent with standard theories of arbitrage. Second, if arbitrageurs do enter, they capture most of the profit in the contracts that they do enter. So they kind of know that what they're doing. So that's our reading of this fact. So third is that the standard pecking order breaks down in that arbitrageurs do not exploit more profitable contracts first, followed by less profitable, followed by less profitable, etc. Specifically, they do not enter almost 40% of the top most profitable contracts. And profitable we measure in different ways by early exercise value, moneyness, potential profits. No matter how you cut it, about 40% they do not enter. So we also confirm this in a regression analysis, some of which uses matching estimators.
Can I jump in here? So, the profitable contract is not the one with the highest early exercise value.
So this is our formula. Somebody complained to us that we are using, what was it using? Black-Scholes and Bates, and we should be.
No. I have a different issue in mind.
Okay.
Right. The profitable contract is one with a lot of idiots who are not going to exercise early, right? So, is it possible that the floor traders know which contracts are likely to have a lot of retail idiots who don't exercise?
Well, if we know that, yeah, and we can predict it really well, I would imagine the floor traders would know that too.
Okay.
And we can predict it almost in real time. So this is transaction level data.
Okay.
Mm-hmm.
So just to follow up on the potential profit thing, the tercel you were talking about is about this product, right?
So because somebody complained that our potential profit depend on the way we compute early exercise value, we now tell us any other metric of the most profitable, and we will include it. We put it as potential profits, top early exercise value, and top moneyness we now put. But if you tell us some other metric, we will include that too. No matter how you cut it, you get the same result.
No, but my worry was, I mean, as you said, they probably very well know which are the buckets that are not going to be, where there's a lot of retail investors, let's put it that way. But then this interacts with the profitability of the early exercise, right? So is it possible that, they know something about it? It just feels like here there's a friction missing. Why would they opt out of the most profitable trade?
We have an explanation.
Okay, let's get to it.
That's our natural markets. So they do not want to step on the toes of very influential market makers. All right, so this is just a fact and very extensively, the one that we extensively document. If you have ideas of how to document it even better, we are very much open to your suggestions. And so the last fact is on the number of arbitrageurs that enter each contract, and that number is very small. Of all contracts that do attract entry, 50% are exploited by only one arbitrageur. So this figure illustrates the distribution of the number of arbitrageurs across all contracts that attract entry. And we have a proxy for it, but in the interest of time, maybe I will talk about this proxy in the Q&A if somebody is interested. And so what we see is predominantly only one arbitrageur. And across all contracts, the number of arbitrageurs simultaneously participating in dividend play in a given contract exceeds 4 in only 10% of the cases and exceeds 10 in less than 1% of the cases. There clearly more than 10 arbitrageurs there on the floor, but they seem to subdivide all these contracts and only enter a subset of them. So the facts that I have shown you are not consistent with standard theories of arbitrage, but they are consistent with our tacit collusion model.
Actually, before you get to explanations, there's a question from Dima. The question is, the change in open interest from pre to post dividend date tells you how many idiots were in the given contract. Do you exploit this fact?
Svetlana, do we do something about it? I don't think we...
No, because in order to... So we use the measure of retail presence that would be available in real time. So that's why we're looking only at sort of, ex ante. But our measures of how much they exploit of the overall volume, that is based on the ex post consideration they share in the overall pie, if you want. But that would be a good idea because we can basically use it to check, double check exactly whether, the guess was correct or not.
Mm-hmm. Thank you for the suggestion. And this is recorded, by the way. So we...
Question. What, these games and presumably profitable opportunities playing on you presented a game theory. The key issue, why, since this is known that they are profitable, why is there no entry there? Yeah, I have an answer, but give me your answer. I would like to hear yours first.
So it's the right time to ask this question. So here's the answer. Okay, so the environment, I think you have already understood that it's very similar to what we have in our game theoretic model. It's executed on the floor, very small number of participants, repeated interactions, because these floor arbitrageurs, they go and have beer with each other every week. So the fixed costs that are in the model is this daily ticker level fee caps, and so they are daily, etc. Now, in terms of the interpretation of the results through the lens of the model. So we interpret contracts with no entry as the natural markets of market makers who are natural writers of options that retail investors buy and fail to exercise optimally. I have a picture on the next slide that I will illustrate it in detail. So the contracts that attract only one arbitrageur are like our market M3, which is not a natural market for any arbitrageur. And the few contracts in which we see more than one arbitrageur, in our opinion, are just misfires. So these arbitrageurs, they just step on each other's toes by mistake. Now, let me talk about these contracts with no entry and illustrate what I mean by the natural markets. So a retail investor buys a call option on Robinhood app. So Robinhood sells it to a wholesaler, say Citadel, for execution. Then the wholesaler engages its affiliated market maker, Citadel Securities, who would take the other side of that trade. So now Citadel Securities has written an option that retail investor bought. Now that written option is in the inventory of Citadel. And should this retail investor fail to exercise the option, forget to exercise the option, Citadel doesn't need to do anything. It will costlessly pocket the windfall gain. Now, other arbitrageurs could technically engage in dividend play and snatch the gains from Citadel. Well, in the tacit collusion equilibrium, they wouldn't. And so in the data, we would observe no entry of arbitrageurs into this contract. Does that make sense?
Well, yes and no. I mean, the fact is, if you like, that there is obviously barriers to entry because you don't make money. Why is it that not more people are getting in to exploit it? I have an answer. The answer is there are barriers to entry. And the barriers to entry are asymmetric information, the primary. The market makers know what's happening more earlier than the others, and also control of the platforms. At least that's what we found in the credit default swaps when we did it.
Okay, so I have a slide with alternative explanations. So let's talk about this, because in our specific setting, some of them are easy to rule out. So let's come back to that. So let me just first test this one. This is just a picture, and you surely want a table to test this mechanism in the data, and we can do that. So specifically, we will regress floor entry of arbitrageurs on a dummy for retail buy imbalances, measured following our previous work, which I have already advertised. And so if this dummy is positive, then market makers are likely to be option writers. That's the idea. And importantly, we run this regression within a ticker and date. They are these ticker date fixed effects. And here's what we find. The most important takeaway from the table is that the retail buy imbalance dummy is negative and highly significant. And this result is equally strong if we restrict our attention to the top tercile of the top profit tercile contracts. So that is, in words, arbitrageurs are less likely to enter a contract with positive retail buy imbalances. And so these contracts are likely to be in the market maker's inventory, that is, belong to their natural markets. And by the way, we look at this photo data that we have from NASDAQ for Felix, and market makers are indeed net short in those contracts that are popular with retail investors. We see that. All right, so now to the alternative explanations. And here I would really like to get more from you, because this is like a paper on gender. People will only believe you if you rule out absolutely everything else. So what we can rule out are transaction costs, because remember, these fee caps are on dividend play are by ticker, not by contract. So, and we see this non-participation even within ticker. So some contracts on SPY that are profitable are exploited, and some even more profitable contracts on SPY on that same day are not exploited. And given that they have already paid the fees are capped, why wouldn't they enter those additional contracts on SPY that they do not exploit? So capital constraints. You said that the trade is virtually riskless. It's not exactly riskless because they are trading long and short nearby contracts. And there could be capital constraints. But this netting, as we understand, happens within ticker. And they are entering contracts within ticker. So for at least the regulatory capital requirements, those are all exposures are all netted. So that what we think. There could be operational risk or stigma. There was one Bank of America Merrill Lynch trader who made a fat finger arrow and lost 100 million on that trade. There could be limited attention. This one we have been able to rule out with this looking at days with multiple earnings per share announcements or market macro announcements when a lot of things were happening on that day, and we still have a similar amount of dividend play trade. And so in the final explanation is risk. And I would like to discuss it with you on the next slide, see what you think. But the explanations that I have outlined here, they imply some sort of a pecking order, all of them. You would still enter the most profitable contracts first, exploit those, then second most profitable, third most profitable, etc. And we do not see that. We see a lot of non-entry, this selective entry into the contracts that are the most profitable. And that's a puzzle that makes it inconsistent with standard theories. Now about risk. So some people told us that there is a little bit of risk in that trade. Why? Well, it is this overnight risk. When you are already exercised your long positions and need to deliver on your shorts. And so the contracts that are exercised, there is no risk there. But there are contracts that are not exercised, where you receive the windfall gain, you have a short option, and then you have a long stock. So there is a little bit of a delta risk there. So only on this like small percentage that are not exercised and that are not assigned, the ones that where you receive the dividend gain. So maybe I confused you. So I have the chart, but I think it's too late in the seminar to show you the chart. Anyway, so you may have come up with your other ideas why there could be risk in that trade. How do we measure risk in options? So the obvious approach is to look at the Greeks. And we have the Greeks. And what we have done, we have sorted all our contracts into buckets according to various measures and looked of risk and looked at the quantities of interest, such as the fraction of harvested trade and how many arbitrageurs enter. And what you could see here, let's look at the delta, different delta buckets. So you still see our result. There is still this selective entry. It's not like options with a higher delta, you would see less, significantly less entry of arbitrageurs, or gamma for that matter, or vega. We also looked at the sort of Sharpe ratio-like measure, potential profits according to our formula, divided by the delta exposure, for which we have a formula that I'm afraid to confuse you, to give you too much institutional detail. And still, we see exactly the same thing. For example, the fraction of harvested profit is definitely not 100%, and it's not increasing and becoming 100% if you look across these 5 buckets. And so from this, we conclude that, okay, there is some risk to that trade. We can not denying that there is none. But even if you control for that risk, and we now added controls for delta in our regressions, we still see we still see our results. The stylized facts are still there. And by the way, so also a call for you. From option metrics, we realized that there are a whole bunch of missing observations for gammas and vegas. If anyone has encountered this problem and solved it by using something else other than option metrics, please let us know. Delta we have from Oprah, that one is great. But on the gammas and vegas, we have a bit of a missing data issue, if you could help
Are they
us.
for you're missing gammas and vegas for in the money options?
Yes.
So for in the money options, it's common that the midpoint violates elementary arbitrage bounds. And when that happens, option metrics doesn't compute the Greeks.
Right. And what's the workaround?
Sorry?
And is there a workaround? Is there another
The
date?
workaround would be to compute, so other people who want to do this, so they don't compute the Greeks because they can't compute the implied vols because the root finder wants it to be negative. So the workaround is to interpolate the implied vol from a nearby strike and then compute the gammas and vegas from that. Option metrics doesn't do the workaround, other data vendors do.
Okay, understood. Oh, thank you so much, Neil. This is really helpful. All right. So now let me conclude. So in this paper, we have a model of tacit collusion of strategic arbitrageurs. We also introduce a concept of a natural market. And in my little graph with the clouds, you saw that this was inventory of leading market makers. So, and our empirical implication produces findings that are consistent with the model. And we believe that our model is more broadly applicable. And in particular, strategic interactions and repeated games are features that could be relevant for more opaque and concentrated markets. And I already have Stylianas's comment, and we will look at your paper. Thank you so much for pointing it out to us as another application of where our theory could work. And so that's my last slide. Just wanted to say thank you. And I finished on time as requested, and I'm ready for questions if you have any or comments.
So at this point, we invite people. Well, we've already invited them, but we invite people again to unmute yourself and shout out any questions that you have or any follow-up questions that you have.
Anna, just while people are warming up, so for did I understand correctly that the capped fees from the exchanges are there somewhat to encourage this trade?
Yep.
So why isn't the first reaction of the SEC just to forbid this cap on fees?
So our proposal to the SEC is actually to change this random assignment. Because if it was first in, first out, then it would completely remove the incentives.
That simple.
Because who knows? And so why do exchanges impose these fee caps? Because they want to get the business, right?
No,
so
of course, but
find another way. But changing clearing rule, there is nothing they could do, right, about it.
So is the fee cap on certain strategies, or is the fee cap just on, if you do a certain size on the floor?
Certain strategies, and there are 6 of these strategies. So one of them is dividend play. Other strategies involve a stock leg, which is why we have not examined them, because it required matching with TAC. So in principle, one could look into for this activity also in those other strategies.
Do you realize this paper is subversive, okay? That in terms of the profession, first of all, it challenges the fact that the entry is free in financial markets, and the financial markets are competitive, and you have competitive equilibrium, which is a dogma, okay, followed by several colleagues that I see around this audience. The point I want to make is, I'm very happy for this paper. It parallels exactly what we found in the credit default swaps, where we found a riskless arbitrage period, which was very profitable, and for some reason it was we couldn't understand why, and then we found out why, because there was a court case that simply didn't let other people to get in and trade. So that was so I suspect there's something similar here is taking place. Probably financial, if you like, information asymmetry. That's
okay, but
why.
Stylianas, what do you think of my argument that we see it within ticker? Let's say SPY, there are 100 contracts that are eligible, that are profitable. 50 of them are exploited, and the rest are not. In fact, I can show you that to make it, Svetlana, do you remember the slide where we had
The argument is complex and I have to think about it, you know.
Yes, so
I'll
this
read
is
it, I
by-
promise, and reply. I mean, this
Yeah,
thing,
so
but it
this
is
is
intriguing. Yeah.
This is by ticker. Yeah, this is what I'm talking about. And you
Yeah.
see millions. So these are SPY, Apple, a bunch of ETFs. And we look at the harvested profits and foregone profits within the same ticker. Yeah, on that day. And you can see millions that are foregone. And then there are some that are harvested. And they have already paid the fee because the fee is capped. Why haven't they gone to the ones that are not harvested?
I don't know. That's do you have an explanation? Why is it?
Collusion. Tacit, not collusion. Tacit collusion.
Yeah. Which tacit collusion, of course, is exactly what was going on in the Great Default Swap. That's why they went after them. And this has not been recognized by the profession. That there is, if you like, market power and control, if you like, because these make a lot of money. I mean, these are not people that are poor. I mean, it is an issue that should attract policy interest. But anyhow, thank you very much.
Thank you.
Can I ask a quick follow-up? So I'm trying to understand when this arbitrage is closed, right? So we have a long call position. This call position will drop in value post-dividend. So we're trying to get on the other side of this trade. And if successful, we will be on the other side. So we'll be short a deep in the money call, right?
Mm-hmm. Yes.
And if we get lucky, then all of this stuff will not be exercised. So post-dividend date, we will be short deep in the money call,
right?
And I have to hold this until expiration, right? How do I get out of this short deep in the money call to make it like an arbitrage?
Yes, so this is a little bit of risk that I was talking about, and I was afraid to confuse you, but maybe instead I should have just showed you this timeline, exactly what you are talking about. So this is what you're asking, yeah? So this trade happens usually in the afternoon of this ex-dividend date, when an arbitrageur will take a long and a short position in the options. Maybe let's make it simple, not nearby option, but the same option contract before the SEC changed the rule. So at the end of the day, so the arbitrageur will exercise all the longs optimally and hold all the shorts. So there is a little bit of delta risk because they are not exactly the same contract. If they're the same contract, there would be no delta risk. But so then they are holding it overnight because clearing happens overnight and all the exercise. And then after the dust is cleared in the morning, so the options that the shorts that were exercised, they delivered against the options that they have exercised. So that one is no risk, yeah? But there is this mismatch that you are absolutely correctly pointing out. So they will have one long one underlying and short one option, the one that did not get assigned. So there is a bit of a delta risk here. So the order of magnitude is much smaller than the size of the original trade. The original trade was huge, 100 in our example, and only a fraction of them is the left unassigned. But yes, there is a little bit of risk. So, and our understanding is that these options are actually quite, most of them are weeklies. So they're very close to expiration anyway. And I think they just hold on to that option until expiration.
Yeah, but basically all of your profits are on this remaining contract because the entire trade is that this long position will lose some value, right? But maybe this value is still within the bid-ask spread because the bid-ask spread for this in the money contract is huge. So now you have something that you have to hold for a week and delta hedge. So that's not something that many investors can do.
Less than a week. So what we find in our previous paper is that retail investors who are big suppliers of these arbitrage opportunities, they have a strong preference for very short-term options, weekly options expiring in a week or less. Now we know many of them have moved to 0 day to expiration contracts. So those, we are talking on average, maybe 2 or 3 days to expiration. Is that a big risk if they even hold it to expiration without trying to cross it?
Well, I have to delta hedge, then I have to deliver the shares. None of those are cost-free, right?
Mm-hmm. Would they delta hedge for just a couple of days?
Of course they will.
They will, huh?
I mean, it's not a little bit of delta risk. So it's a little bit relative to the overall mumbo jumbo that they're doing, but they're only profiting from this one contract.
Right.
So all of this 100 and plus 100, it's all kind of netted out. It's not really relevant. What's relevant that there's a loan contract will lose like 5% in value, right?
Mm-hmm.
Overnight. And we're making this 5%, and then we're trying to keep as much of this 5%. So I'm just kind of trying, would be nice to have some kind of rough estimates about how profits compare to those kind of potential costs of delta, initial delta hedging, holding until expiration, dealing with all of that stuff.
Okay, we didn't put the costs here, so we know that there is a delta mismatch because they're long underlying and short is call. We just controlled for delta in our tests. But yes, so okay, let us look into the costs, assuming that they would delta hedge, not get rid of it, yeah, because it's just too costly to cross the bid-ask spread, right?
Well, I mean, if the option bid-ask spread was 0, they could close this position the next day, right? But they don't, and then it becomes.
Mm-hmm.
Yeah, but how do you know they don't? I mean, they could be, right?
Well, it's sort of like if they can close the deep in the money call at midpoint, all power to them. So this is might be why there is only some investors who are doing this, because at the end of the day, you're left with deep in the money call, short deep in the money call, which made a couple of % profits, and then you're trying to close this position as close to the mid quote as possible. What Anna suggesting holding until expiration for a week or so, but then that also like non-trivial.
Mm-hmm.
Yeah. So I had a kind of different view on this, but I'm stuck on the portion of the data of the arbitrage opportunities that they don't exploit.
Mm-hmm.
And I was wondering if the reasons why they don't exploit those is because they foresee these options being harder to close the day after. So, they know that tomorrow they will want to trade to close this. If they if there are contracts that they think that the bid-ask spread tomorrow is going to be easier to handle, then they might opt out of the harder to close options. But
right. So I do not have this slide, unfortunately. We have it in the paper. Oh no, we have. Okay, I do. So what we did to address this in our regressions that they do, that show that they do not enter and what explains entry, we also control for delta or the quantile of delta. So you're right, it does come out as significant. So there is some of that. But remember what our main variable is dummy. And the dummy, no matter how you cut it, so if there is a retail buy imbalance, they do not enter. That one, it just doesn't knock it out. So if there is a better way of doing it, do tell us. But you told us to compute it some cost of this.
What does the delta estimate mean? Does it mean they enter
risk
when the delta is higher or lower?
So when delta is higher, there is more risk.
There is more risk.
Mm-hmm.
Yeah, like time to expiration will be another one, because do I hold this call for 3 days or do I hold it for 1 month? The option bid-ask spread would be a more direct measure of the cost of potentially closing position immediately. Stuff like that would be helpful to add.
Okay.
I thought the delta of these options are close to 1, no? Or I was.
It is very close to 1. I should have mentioned that. I'm so sorry. Yes. So that's why the difference between the two. I'm so sorry. Yes.
Okay.
Svetlana,
So in that case, probably they don't need to do other kind of a hedge system, throwing it off, right? If it's 1 minus something close, very close to 1, it's just up to a calculation.
Exactly.
It's very hard to hedge those things anyway in a dynamic sense. It's more like if nothing dramatic happens, it'll be there anyway.
Yes, so you're saying that they are just not hedging it, yeah, consistent with what we've heard.
I'm thinking if it's very close to 1, deep in the money, it's hard to hedge. It's hard to hedge.
It's hard to hedge.
I
And
mean,
so,
with 0.9599, your calculation of the delta itself is problematic. Probably it's better just to leave it alone. Because this is a delta close to zero anyway.
our delta is from Oprah. How good are their deltas? And we also have from option metrics.
But it's fine. It's all close to 1. You don't care whether it's 0.99 or 0.98.
Yeah, that's what I'm saying. At that point, I guess it's all calculation error and execution error. So not doing anything probably is better.
Well, but this is in the money call. You have to short sell to delta hedge it. So if you have a position with a delta 1, it's equivalent to holding like a short position or a long position in the stock. So you expose.
You have a long position in the stock. You have a long position in the
because
stock.
it says its exposure is 1 minus delta, which is pretty much zero.
No, I mean like the long position is an idiot and the short position is me. So I'm keeping a long.
It's you. Both are you. Both are you.
Oh, okay. Yeah, then I misunderstood the strategy. Sorry.
Yeah, so you simultaneously buy and sell the exact same number of calls.
Just again, sort of this simplified assumption, because here we're assuming that both the sides of the long and short positions are kind of the same in terms of number of contracts. That's why the net exposure becomes something like 1 minus delta. And so from that perspective, the closer you are to 1, the larger is the delta, the smaller is going to be the risk that the overnight hedging sort of here implies. But obviously, for example, if you go to the contract with a higher maturity, like, or higher, strike, for example, you do not necessarily need to buy like 100 of them. You could buy, let's say, 99, and in which case the kind of hedging is going to be even better. But the average delta that we have in our sample is extremely close to 1. So it's literally something like 0.95 or not 97.
I mean, if there are other questions, go ahead, but I'm still confused about the strategy in a sense. In the very beginning, there is an idiot with a long in the money call who will not exercise it. If I'm lucky, I'll get on the other side and I will be short this call, which will lose some value the next day. So it means that there will be capital gains to me and capital losses to the other guy.
That's right.
So,
But simultaneously, you're also long 100 nearby calls with a nearby delta.
oh.
And you exercise all of those optimally.
The reason you want to do that is because in order to get that single contract, which is not executed by a retail investor, you would need to essentially have your position in these millions of other contracts first.
Yeah. But after the dust is settled, so I already established a delta hedge for other contracts. That's what you're saying.
So the other leg of the strategy, so here, for example, buying those stocks, right? So these are going to be exactly providing you natural delta hedging for your overall portfolio.
Yeah. Okay, so you already have,
Yes.
you have like 2 in the money options. One is long and one is short.
That's absolutely right. So that's why we're calling the strategy virtually riskless. And this difference between delta and 1 for a very small fraction of that position is what makes it virtual and not perfectly riskless.
And number of underline is the underline. So you're buying one underline and shorting one option.
That's right. So it's 2 nearby contracts on the same underline.
But if you're long call and you're not exercising, you're suffering the same capital gain, no?
Yes, but you would, why would you irrationally not exercise it? They all rationally exercise on this call.
Yeah, but besides short call, what else do you have after the dust settled the next day?
After the dust settles, okay. So if there is if everything are exercised optimally, you have absolutely nothing. So you have yes, but if one contract in my example is not assigned, then in the morning you will have 1 share, 1 underlying, and 1 short call with a delta close to 1.
Okay.
And we still should control for time to expiration and bid-ask spread, as you told us, yeah, not just the delta.
Well, you're mostly delta hedged, but yeah. So you're stuck with this contract like for a week or for a month, depending on the maturity of the option.
Yeah, and Luren just said that you would normally not get rid of it.
Well,